Thursday already. Hey, it's Mitch Goldberg. You know who I am, and I'm so glad you're joining me. Thank you very much. This is Be the Boss of Your Money. You know the deal. It's my live stream. We talk about personal finance, investing, stock market, the economy, borrowing, mortgages, getting ready for retirement, getting ready to pay for your kids' college education, insurance, long term care. I mean, if it has to do with money, we talk about it. The idea is to help educate you about your money so you can take control of your money, right? That's why it's called Be the Boss of Your Money. It's very easy for your money to become the boss of you. And when your money's the boss of you, only one thing comes of it: you run out of money. And well, what follows is stress, damaged relationships, bad emotions, and just a shitty life. It's amazing um, how much good financial habits, you know, impact your life. It's just you'll never meet an unhappy. Well, I shouldn't say that, but generally speaking, people who are, how do I say, people who are exuberant with money or who just can't hold on to a dollar. They make a couple bucks, they spend it. It's they regret it. But sometimes people are on this vicious cycle and they can't stop. It's kind of like overeating. I have a really good friend, Michelle, who's a nutritionist, and we always talk about how similar healthy eating, healthy lifestyle choices is so similar to healthy personal finance. Just someone overeats, they're heavy, it's not good for them, diabetes. You could tell them till they're blue in the face, this is not healthy, but they just can't help it. And I'm trying to help people shake that. And one of the things I talk about is goal setting and trying to figure out what could work for you. Like I was talking to somebody about budgeting, and budgeting is hard. And some people are naturally good at it, but you'd be surprised how few people are naturally good at it. The people who are really good at budgeting, I find that, and I know some, look, I know some really wealthy people in my life, and I have a pretty good clientele. I'm not saying that you have to be super uber wealthy to be my client. That's not the case. Just want to throw that in there. Uh, what I am saying though is the people who are really good with money, it's not just because they have a lot of money or they make a lot of money or they inherited a lot of money. They're good with the money that they have, no matter how they get it. They're good with the budgeting. And one of the things that consistently works for people who are good with money is you take a look at all your bills and everything you have to pay, and they just say, these are the priorities. And they get rid of everything else. And that doesn't mean they say, I'm necessarily getting rid of Netflix and I'm, never going to spend on something discretionary uh, or something that brings me joy again. That's not what personal finance is all about. If you think personal finance is just living on bread and water and living in a box and never spending money again, if you think that having such a scarcity mentality is what's going to, make you good with money, it's not the case. It's just like saying, I'm never going to eat a piece of chocolate again. I'm never going to have, a donut or a piece of cake again. That's like, it doesn't work. Yeah, and you're going to see everything in moderation. You just have to know that sometimes when people do something in moderation, it's like a gateway drug in a way to do something even more. Like, I'm just going to have one piece of cake. And an hour later, they ate the whole thing. Well, maybe you were really hungry. And once you eat the cake, your dopamine starts circulating around your brain and you just keep going. So you need to have a strategy that says, I'm going to eat something healthy before I get to the cake. This is why we always say you eat dinner first, then dessert. Because when you're really hungry, for example, you make the worst uh, food budgeting mistakes, the worst calorie budgeting mistakes. Same thing with money. When you feel deprived, it's not a good thing. Deprivation is not a good way to go. Scarcity mentality is not a good way to go. So I'm just giving you an example of the things you talked about. I just spoke with a new person, really nice person, just for the first time now. And so if you're watching, I'm giving you like a taste of what we talk about here on my live stream. So I do this live stream to help you. Um, it, It helps build my business. There's nothing sales pitchy about it. I don't throw anything like that at you. But if you would be so kind, give it a thumbs up, a heart, an applause, a wow, whatever reaction is available to you, depending on which social media platform you're watching on. I stream to Facebook, to LinkedIn, to Twitter, to YouTube. So that would always help me spread the word out about the show, the work we're doing here. And then what happens is if people are looking for a new financial advisor, they'll think of me and come to me. That's the key. So just so you know, we had a merger with my business. Staff was on vacation last week. This week we're just getting into it, and it's already Thursday. So hang on, we're getting to everything and to everybody. But damn, I'm having a lot of fun. What we're going to talk about today is the stock market versus the economy. All right, because the stock market is going up, and it should be going up, in my opinion, because it doesn't have as much to do with the economy as you think. So we're going to get into that, give you a quick summary of the day. I'm going to roll the intro now, and just stick with me. If you have any questions, hit me up in the comments. You want to just say hi? That's cool. Say hi in the comments. Words of wisdom, words of encouragement are always appreciated. So while you're watching the intro, I'm going to have some iced coffee. Here we go. Okay, thank you for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money. Happy Thursday. I typically, so you know, I don't do these live streams on Fridays unless there's something really crazy going on in the market. Like if if the Dow is down like 800, 1,000 points or something tomorrow, I'll be here doing the live stream. But other than that, doing this 4 days a week, Monday through Thursday, is it's a lot, and it's more than enough. So that's that. So let's talk about the economy first, because if you go by the economy, you should not be in the stock market. Well, let's go back a second. If you're saving and investing for the long term, then all of the stuff that's going on in the economy now is not really relevant to you, depending on your age and the life cycle that you're in. Now, if you have children a few years before college, you obviously don't want all of that, their 529 plan money or their uh, custodial account money invested, if that's going to be used for something in the near term. When I say near term, I'm talking a few years, not like 6 months or 3 months. So it's the life cycle. So I don't particularly get worked up about the stock market. A friend of mine called the other day. You know, it's a lot going on, the market, everything. And I told her that it's actually my cousin who called me, and I said, I'm I'm good. I've prepared my clients for this. Having you know recessions, bear markets, down markets. This is all built into the plan. But the key is my clients, for example, who are facing retirement, enough of their money's moved out of the stock market into cash to help pay for their needs. Like if they're going to buy a home in Florida, for example, that's not an emergency expense. That's something that is a planned expense. Now, an emergency fund is completely separate. The emergency fund is in cash. That is not going to be used as part of the money to buy the home in Florida. Now, if something happened to the home in Florida while you're living there and a hurricane rips your roof off and you need a quick $50,000, $60,000 to replace it, well, you could definitely use your emergency fund for that. Okay. But hopefully you have insurance on the home so you don't have to pay for the full whole retail value of the roof. Just saying that. But these are the things we talk about during the live stream. So what I want to impress upon you is that I don't get phased by markets, by market ups and downs. I've been doing this for 32 years. And if I got phased by a down market or an up market, um, I don't think I would have been able to last as long as I have. It's just, you eventually just become immune to the ups and downs, and it just becomes managing the things you could control and letting the process just take care of itself, manage the process, and trust the results. Okay. Trust that the results will come. So that's why I don't make such a big fuss about an up market or down market. If anything, I think it's fascinating. I think markets, politics, the economy, and how it all interacts is fascinating. I'm not a political guy. If anyone who knows me, I'm not really a political guy. But I do love how it's just fascinating to me. So I love this business because so many things are at play in the market. It's all about psychology. Politics is about psychology. The market's about psychology. The economy is so about psychology, and it's just really fascinating to me. This whole thing, behavioral finance is a big part of it. It's just a cool place to be in my industry, and I'm lucky that I find it fascinating. But anyway, let's talk about the economy. Inflation is here. Layoffs are going up. First time unemployment claims are also rising. And it looks, I think we are in a recession. Actually, Bank of America came out and said they think we're in a recession now too. I've been saying this for months, for like the last 2 months. I've been saying we are in a recession. Uh, it's just the economic statistics that people look at to say we're not in a recession, like employment figures and GDP. Those are very lagging indicators. But next week, the preliminary GDP numbers come out for the second quarter of 2022, the one that just ended this past June 30th, right? And it could be negative, which would put us into a technical definition of recession. We had a negative GDP quarter, first quarter, negative GDP second quarter, so 2 quarters in a row. Well, that's not the only definition of a recession. You remember in 2020, when the pandemic started, we had like a 6-week recession. So it wasn't 2 quarters. It was a very brief recession. So having said that, let's say that if you go by the economy, you should be hunkering down. You should be scared about your job, worried about your job security. And that's what happens in recessions. And then people stop spending money or they want to hold back on things. And there is evidence of that happening. Okay. If you look at Netflix, for example, lost 1 million subscribers in their earnings report 2 days ago. People are cutting back on things. There was a rush into vacations and flying because we came out of the pandemic. People wanted to get out and travel. But even, airlines are saying they're seeing somewhat of a little bit of moderation in the growth of the numbers of passenger volume. So we'll see how it all shakes out. But things aren't great, and there's worries that the economy is going to get worse. And yet the stock market is rallying all of a sudden the last week and a half, 2 weeks. Like, holy cow, we are back in business. The economy is going to boom, and everything's good. And let me tell you something. That's how it always works. And people are, investors always caught flat-footed saying the economy stinks. Should be the market. But what I'm telling you is there comes a point when the stock market starts to anticipate better times ahead. It starts to anticipate an easier Federal Reserve. The Federal Reserve, the central bank of the United States, is raising interest rates, slowing the economy down, pushing demand down to help fight inflation. Pushing demand down does one thing. It slows the economy, maybe so much that the economy goes into a recession. We don't want that. But having really high inflation for a very long time is a lot worse than going into a recession. Because eventually you go into a much deeper recession with long-lasting inflation. Okay, so the medicine is bitter, but necessary. And there's a lot of things that the Fed can't help, like supply chain issues. The Federal Reserve does not build semiconductor plants. It doesn't build supply chain management software. It doesn't build auto parts, all of the things that the economy is missing, which is one of the reasons why there's so much inflation. The Fed can't do anything about the extreme heat in most of the United States now and all over Europe. Plus, there's a war going on, Ukraine, and it's a lot going on. And these are reasons that you would be negative about the stock market. Again, the stock market's going up. What I've been saying is by the time you get to the point when there's realization we're in a recession or close to it, the stock market already starts to go back up because the Fed is, basically anticipating that it's going to stop raising rates. Maybe they'll lay off, lowering their balance sheet. The Fed has about $9 trillion of securities. They'd like to reduce that by trillions. That has the impact of slowing the economy down, of lowering credit growth. So these are some of the things that are taking place. They're big things. The dollar's been very strong until today. Finally, the European Central Bank raised interest rates for the first time in 11 years. So all of a sudden, it makes the euro a little bit more competitive with the dollar all of a sudden. So the dollar, relatively speaking, has come down a little bit. And that's actually pretty good for corporate earnings, especially for multinationals, right? So let me just put these on. I want to see who's out there. We've got a heart out there. Who's there? Heather, nice to see you. Thank you so much for joining me. Really appreciate that. And we have Carmine out there. Hey, Mitch, hope all is well. Carmine, I hope all is well with you. I didn't forget about you, but it's summer. So how about this? Let's you and I communicate tomorrow, and you and I need to put that lunch on the calendar because we've been talking about it for so long, and you've been such a good supporter, and I really appreciate you reaching out to me when all the stuff was going on with my wife. It means a lot to me, and I don't think for a second that I would ever forget that. Heather says, "Hey y'all, y'all, so nice to see you, Heather. Love that, y'all. You know, because you said that once, I say y'all look so cute and things like that. I just love that, y'all. You know, thank you, Heather from South Carolina. Hope I didn't give away a secret by saying where you're from, but it's on your Facebook page. Okay, so that's what's going on with the stock market. The stock market is already anticipating a big thing. Inflation has peaked. So inflation has peaked. Oh, what do you say? The market is so exciting, y'all. I guess you could say y'all at the end of every single statement, right? This lobster roll was awesome, y'all. You could say that. You could literally put that in anything. You know, I'm going to start doing that. It's going to become like a really bad habit. I'm not going to be able to stop. It's kind of like when I start saying the F word too much. You know, once I start saying the F word and I do my F speak, it's like I can't turn it off. It's like, could you stop saying the F word every second? I'm like, I can't. You know, the F in market, the F in stock. I got to go get my F in car. I go to the F in office and pick up the F in thing at the store and wait for the F in Amazon guy to get here. And then, you know, it just goes on and on. So thanks for joining me. I'm a little punchy, I guess. It's Thursday, you know, it's a good week, right? Going by fast. It's like I'm going to be out tomorrow. Yeah, I'm going to actually be at a golf outing tomorrow. I'm not playing. I'm going to volunteer. I gave up golf. I'm a reformed golfer, which means I literally stopped playing golf after being a golf nut for like 20 years. I don't miss it, which is the really weird thing. So we've been talking about this. Inflation has bottomed out. It's peaked rather. Inflation has peaked, and the market's anticipating that. And now that the inflation has peaked, the market, investors are going back into technology, which is why the Nasdaq is up so much this week. And rates are coming down or expected to moderate and not go up as quick. This is very good for tech stocks. You know, Tesla led the way. Tesla was up a lot today. And I'm really pissed. I said this yesterday. A friend of mine asked me, should I buy Tesla before earnings? And I said, no. What I really should have said is, it depends what you're looking for. You know, sometimes you just don't give the right answer when it's off the cuff and somebody just asks you out of the blue. And, you know, nobody's perfect, right? But really when somebody, at least in my office, this was like on a Sunday afternoon, we were at the beach, someone asked me, but, you know, when I'm in my zone, the question is always this: should you buy Amazon because it's going to split 20 for 1? On Monday, Alphabet, which is Google, started trading on a 20 for 1 split basis, right? And people say, should I buy the stock now that it's split? Like, if you want to own Google and that's your goal, you buy the Google or the Alphabet or the Tesla. Okay, if I want to buy a cup of coffee, I buy my goddamn cup of coffee. If you want to buy something and you have the money to do it, then do it. Now, is it part of a sound financial strategy, part of your financial plan? Do you have the money to tie up? Do you have the ability to tie up that money for a very long time while you wait for the stock to go up? If you have to sell the stock at an inopportune time and the stock is down a lot, but you need money, will you be able to absorb the hit, the loss? That speaks to your risk tolerance, by the way. So then you're talking about something different. You just expect to make money on a quick pop. So yes or no. Or if it goes down, then were you wrong? If you bought an earnings and went up, yeah, you're right. But post split for Amazon, the stock went down a lot. So were you right to buy it for that? No. So there's a lot more to it than just saying, should I buy the stock for this, for that? Unless you're really just trading and you're really trying to micromanage your accounts. That's a different story. Okay. And Heather says, yes, you should buy Tesla before earnings, but only if the timing is right. Well, yeah. You mean like the personal timing for your life, for yourself? Like if you have the money aside and you could leave it in Tesla for a few years if you're wrong while you wait? Are you investing in it? Are you trading it? Is that what you mean? Or do you mean if the timing is right for the stock? Because my whole point is you really don't know if the timing is right for the stock until after the fact. Maybe Tesla could have missed and the stock could have gone down, right? Expectations were pretty low and that helped. So, these are all the things that go into it. Anyway, let's just take a look at how the markets did today. Okay. Let's see. I'm just going to look at a couple of things here. Snap. Let me just put the screen up. Let me show you what I'm looking at. Hold on. It's not letting me go to my extra screen. I'll tell you what I'm looking at. Okay. I am looking right now. Here. Snap. Snap is down 26% right now in extended trading after a miss on the top and bottom line. So should you have bought Snap for the earnings, right? That's what I mean. Therefore, Meta is down after market trading because of that. Mattel down 2.8%. Capital One, the bank and credit card issuer, down about 5% after market trading. Intuitive Surgical, holy shit, there's a lot of bad shit going down here. A lot of bad shit going down here in aftermarket trading. Intuitive Surgical, down 12.6%. Boston Beer, down 8.4%. Just like bad news all around. Wow, just all the, every day CNBC comes out with the stocks making the biggest move after hours, and everything's getting slammed. Everything's getting squashed. All right, for some reason, I'm not able to go to my fourth screen and show you how the markets did today. But I want to tell you this: the 2-year yield is 3.09, and the 10-year is 2.88. So we still have an inverted yield curve when short-term rates go above long-term rates. It's called an inverted yield curve. It's a really reliable indicator that we're in a recession or going into one. It's still a pretty strongly inverted yield curve, but the 10-year yield did drop down to the twos again, and that's one of the reasons why you're seeing the NASDAQ go up so much. And I just want to take a look at the VIX. I'm really annoyed that I can't put this stuff up on my screen right this second, but the VIX is down to 23. Remember, I gave you those benchmarks, first 25, then now it's 23, but if it gets up to under 20, you do have yourself a real solid rally that continues on your hands, in my opinion, and based on my historical analysis. Okay. By the way, you can't invest into an index fund, but you could invest directly into a security that tracks or mimics an index. Got to get those disclosures in there. Oil down. Wow, oil got shellacked. Oil is down over 3%, down to 96 and change. Have you noticed at the pump when you drive by, I'm seeing gasoline at like $4.39 around town? Have you been seeing that? So gas is coming down. If we could see a 3 handle on the gas, I think that would be a very positive move up for the economy. All right, Stacy is out there. Thank you very much, Stacy. You are such a good one. Thank you. Dang, you were such a good one. That's it. Can I get back to my other screen? Up. Every time I try to click camera 4, which is my screen that I share with you, it just freezes up. So it's no big deal. We're going to call it a day now. I've got to get somewhere. I know you've got things to do also. I know we're all very important. But if you do have any questions or anything you want to ask me in the comments that you think of later, go ahead and ask, and I will definitely see those. And I can't wait to get back to you. Thanks so much, and have a great weekend coming up. Bye.